All right, Himanshi, we'll start recording.
Started, ma'am.
Okay. Good evening, everyone. I'm Dr. Srishti here. We are here again with our monthly financial wisdom understanding from the experts. And I would like to welcome a very special guest who is here with us today. Welcome, Mr. Zafar. Thank you so much for agreeing to come on our webinar today, and really thankful to you. Let me introduce you all to Mr. Zafar. Mr. Zafar is an accomplished stock market professional with a strong track record of analyzing financial markets and making informed strategic investment and trading decisions. He's proficient in both technical and fundamental analysis and using these tools to identify market trends and seize opportunities. His expertise spans developing and executing investment and trading strategies, managing risk effectively, and maximizing returns for consistent income generation, and long-term wealth creation. Originally trained as a mechanical engineer, Zafar transitioned into finance after discovering his passion for the markets. Zafar runs a successful asset management business through mutual fund and PMS distribution, channeling his market expertise to help clients grow their wealth. In addition, he specializes in trading futures and options with a short-term focus for income, while investing in multi-bagger stocks with a long-term perspective for wealth accumulation. He also shares his knowledge through a dedicated multi-bagger investing program, training others on identifying high-growth stocks and maximizing investment potential. So thank you so much, Zafar. I'll hand over the stage to you.
Thank you, Dr. Srishti, and welcome everyone to this webinar. Is everyone able to see the presentation? Dr. Srishti?
So you have to reshare it.
Yeah, please reshare it. Yes, we can see your screen now.
Okay. So welcome to this webinar. The topic of the webinar is building investment portfolio. And we are going to cover this in two components. One is strategic allocation and second is tactical changes according to the market conditions. So let's get started. First of all, we will cover what can be the core asset classes in an investment portfolio. First of all is equities. Everyone knows equities is basically stocks. There are various ways to invest in equities or stock. It is a high risk, high return asset class. This is suitable for long-term growth. The usual compounded annual growth rate of equity asset class is around 12 to 17% if we talk in terms of mutual funds. Now, this growth or this CAGR is not linear. There are phases in the market where market becomes highly volatile and also goes in downward phase, which we call as bear market. So in bear market, these equities can give you a drawdown or losses up to 25 to 30% or even more in some cases also. So that way it is very high risk, but again, because it is a highest return asset class, so the focus should be in equities for building an investment portfolio. Second is debt instrument. Debt instrument is nothing but your bank FDs or debt mutual funds. It basically provides stability and income, and it reduces portfolio volatility because it is not volatile like equities. The FDs or your debt funds will keep on giving steady returns in the event of equities giving you negative returns. So it's in some way it balances out and provides stability to the portfolio. The returns generally are in 5 to 7% range. Third is gold. It is an excellent asset class. We already know that Indians are in love of gold. It is an excellent hedge against inflation and economic uncertainty, and it has a very special role in balancing the volatility of equities. We'll see that in the session on tactical changes. The compounded annual growth rate of gold is around 10 to 12% CAGR. Then it is real estate. It's a physical asset, potentially offering income as well as capital appreciation. If you give it on rent, then you receive the rental income. But it is an illiquid asset, and it's a big ticket purchase, and you cannot move in and out of real estate so easily. So the focus of this session is not in real estate. We'll focus on other asset classes. Last is cash. Obviously, it is not an investment. It generally, cash is basically your money lying in saving account, and it gives you 3 to 4% CAGR. It is not an investment, but I just wanted to include it to make you understand that how the cash lying in an account is an opportunity loss. Okay. So now these are the various assets with different CAGR rates. Let's see. On 1 year basis, if equities are giving 17% or gold is giving 10% or debt is giving 7%, then it will not make much difference in your portfolio. However, if you have a longer term view and you understand the compounding, then what this CAGR rate difference can do to your portfolio. So if you are holding cash in your account or in saving account, after 20 years, it will maximum grow to 2x. If you are holding gold, then it will become 10x over 20-year period. But if you are holding equity, and especially if you are holding a highest return category, something like a small cap mutual fund, then generally it yields 16 to 17% kind of return. So if you have that 17% kind of CAGR, then over a 20-year period, your portfolio will become 23x, and that will create humongous wealth. It will help to retire you early. So equities is very important asset class to focus while building the investment portfolio. But again, because it is volatile, so we have to understand the hazards and see how we can basically make tactical changes to the equity portfolio so as to provide more stability, reduce risk, and as well as optimize the returns. Now, what is basically asset allocation? It is the purpose is to balance risk and return based on risk tolerance and goals. Now, as we have seen, all equities have different volatility profile, so we cannot have a large allocation to any one asset class because that volatility may not be suitable for everyone based on their risk tolerance. So there are two more important factors while deciding the asset allocation. One is risk tolerance. You have to understand what kind of risk you are comfortable with. Although we know that equities can deliver a very high return, but if you are not able to sleep at night when the market is going down, then obviously you are not comfortable with that risk. So first you have to understand what is your risk tolerance. Are you an aggressive investor, moderate investor, or conservative investor? And based on that, you have to decide your asset allocation. Second is what is your goals. So there can be three different goals. One is capital growth, especially for the youngsters who doesn't have much liability and who are just starting their career. For them, if they can grow their capital rapidly, then it can help them to retire early. Nowadays this fire movement is catching up. So when you are young, you should have very high risk tolerance or risk appetite, and you should invest in the asset classes which provide highest return. When you reach mid age, obviously there are certain large commitments like a child's education or marriage or purchasing a house. And in that scenario, you may not be able to tolerate very high volatility or build an aggressive portfolio. So in that period, steady income generation takes precedence more than the capital growth. So in that scenario, again, your asset allocation should change. And then comes the distribution stage of capital, which is basically retirement. So in retirement, you don't want your capital to grow at rapidly, but more important is capital preservation so that you don't lose your hard-earned money or you don't face difficulties in the stage of life where you don't have any other sources of income. So in that stage, capital preservation becomes more important. Now, what is strategic asset allocation? The strategic asset allocation is focused on long term. You have to decide what is your investment horizon. For somebody who is 20 years old, his investment horizon is going to be his total life expectancy, which is something like 60 years. For a retired person, the life expectancy, if it is 80 and if he is of 60 years age, then his horizon is going to be 20 years. So you have to decide what is your horizon of investment, and based on that you have to choose which assets are going to be delivering the desired goals for you. So there are three factors for strategic asset allocation. One is risk profile, whether you are aggressive investor or conservative investor. Second is your financial goal, and third is time horizon. Now what do we do basically in strategic asset allocation? Uh, we allocate our investment in certain fixed percentage way to different assets. Okay, what can be an example portfolio? A portfolio consisting of equity 60%, that is it may be mutual fund which is having 60% allocation in the portfolio. There might be debt or FDs which are 20%, and there might be gold of 20%. So this is just one example portfolio. We can build any different type of portfolios based on risk profile, financial goals, and time horizon. Now, one question always come, what should be the equity allocation in a portfolio? And there is no certain fixed method or fixed we can say a guideline for that, but general thumb rule is that the equity allocation in your portfolio should be 100 minus age. So let's say somebody who is 20 years of age and he wants to invest in the equities, then 100 minus 20, that means 80% of the asset should be in equity portfolio. Whereas if somebody is retired and having an age of 60 years, then 100 minus 60, that means 40% of the equities should be in the portfolio, so that there is some growth to the portfolio, but also not too much volatility. Now, as we have seen, equity is the highest return class. So let's focus on the equity investment. Let's explore it in more detail. So what are the products available for equity investing? First of all is direct equity. You can directly buy stocks in your demat or portfolio. Another way of doing direct equity, which has come up recently in last 4 or 5 years, is a product called small case. So small case is also a form of direct investment, but here the decision of buying and selling is not done by you. It is done by a fund manager. There is a platform called small case, and SEBI registered investment advisors or research analysts create their stock model portfolios on that platform, and you just have to decide how much you want to invest in that product, and it automatically calculates how much stocks, which stocks and how much stock should be bought, and it buys directly. So first approach is you deciding what to buy and how much to buy. Second approach is a fund manager deciding, but it happens in your demat account. Second is equity mutual funds. In mutual funds, there are many categories, like there is debt fund, equity fund, hybrid fund. For the purpose of discussion, we are focusing on equity mutual funds. So there are primarily three categories in this. One is active fund, which is managed by the fund manager. He makes the decision which stocks to buy, which stocks to sell. Second is index fund. So what is index fund? Basically, we have this various stock market indices like Nifty, Sensex, or mid cap index. So basically, an index fund just tries to copy that index performance by buying the stocks which are there in the index and replicate it. And there is third category of ETF. ETF is also mutual fund, but the difference is that ETFs are traded on stock exchange platform like any other stocks. So if you want to do active fund or index fund through you can say AMC, then you have to put in a separate mutual fund application to buy or sell that. Whereas in ETF, you can, if you have a demat account, you can directly buy it on the exchange platform. Then another category of PMS or AIF. These are basically high ticket items. PMS requires minimum commitment of 50 lakh. AIF requires a minimum commitment of 1 CR. But as per analysis done by me, there is not much difference in performance with respect to equity or PMS. So if you have that kind of you can say capital, then you can opt for PMS or AIF. Otherwise, the equity mutual funds serve the purpose for most of the investors. Now let's discuss direct equity, where basically you are buying in your own demat account based on your own discretion. What are the benefits of it? This full control and flexibility, so you can decide what stock to buy, when to enter, when to exit, and you can do short-term rapid changes in that, and try to generate higher returns. So there is a potential for higher returns in that. But what are the risks? Obviously, it requires a lot of time. Let's say you are building a 30 stock portfolio. So you have to understand those 30 stock, do in detail study of that. And then for that and doing study, you need to have some kind of knowledge, like a fundamental analysis or technical analysis. So it becomes time consuming. And also because the market is so random and dynamic environment, so making decisions in that environment becomes stressful. Now, this direct equity, for whom it is suitable, I will say that the mutual funds, PMS and AIF generally cover the top 500 stocks of the market. Okay, there are on NSE, there are more than 2000 stock. On BSE, there are more than 4000 stock. If you are looking to buy Reliance or HDFC Bank or Asian Paints in your portfolio, then I will say that rather than doing that, there are so many talented and talented people who are basically building their portfolios using these top 500 stocks. So if you are doing direct investing and buying this kind of large cap blue chip stock, then I will suggest that better you go for the best products available in the market, which can be mutual fund or PMS, and let the fund manager make the decision for buying that, and you have a peaceful life. There won't be much difference in the performance. But if you are passionate about direct equity and if you are looking to if you are willing to look beyond these top 500 stocks on the NSE, most of these stocks beyond 500 are micro caps or small caps. So if you have, they are highly volatile. So if you have that kind of risk appetite, and if you are willing to tolerate the volatility associated with these stocks, then only the direct equity option should be explored. Otherwise, you are better off doing mutual funds or PMS. Now, since pandemic, we have seen that the market is on a one-way street, and everybody, whoever comes in the market and doing direct investing or mutual fund investing, he is making excellent returns. And in last 4 years, small cap have performed outstandingly. People have made a very fantastic return, something like 35%, 40% CAGR. And now people are extrapolating those returns into the future. However, market has cycles, and it doesn't work in this way that if you have got 40% or 35% returns over last 4 years, you'll keep on getting that over next 10 years. So what is the proper way to compare? So I did this analysis of comparing the returns in similar conditions. Like there was a bull market sometime back, let's say 5 or 10 years back. From that peak to the current bull market peak, these are the similar conditions. Again, if there was a bear market, from that bear market bottom to the recent bear market bottom. So these are similar conditions. And if you compare this similar condition, then you will get the proper returns that you can get from mutual fund. So this table basically compares the bull market to bull market peak mutual fund returns. I have taken various periods where basically market topped out. So this was December 07 top, which was the top before global financial crisis. And you can see what are the various category returns. You will see the best category return is in small cap fund, followed by mid cap fund, and the worst category is large cap. Similar picture you will see everywhere. The percentage returns will differ, but you will see that small cap and mid cap, these are the best category which are giving you best returns in the market. Whereas large cap, although they provide comfort, and because people don't like volatility, so they want to have that comfort of large cap, but it is not a good category to invest if you are looking for growth. If you want a stability or low risk, then it is fine. But if you are chasing growth, then you should have mid cap and small cap mutual fund in the portfolio. Obviously, this mid cap and small cap come with its own volatility. We'll see how to tackle that volatility in tactical allocation. Now, how to build an equity mutual fund portfolio? So there should be a diversified portfolio. The reason being that even if you take a top performing scheme of last 3-4 years, there is no guarantee that it will be top performing over next 3 to 4 years. So diversification is must. What should be the size of portfolio? In my opinion, the number of schemes in your portfolio should be minimum 4, maximum 8. More than that, it doesn't enhance the reason, enhance the returns. It complicates the monitoring of the portfolio. So 4 to 8 schemes are more than sufficient. Let's take an example. If somebody is who is in 20s or 30s and he is an aggressive investor and he wants to build a portfolio. So how should be the portfolio composition? Pick up 2 small cap funds, 2 mid cap funds. 2 can be sectoral based on based on the sectors or themes which are performing good recently, or it can be an index fund. And for the purpose of diversifying away from the local market, one can have a global fund. So this is just an example portfolio, but this is the way you should construct the portfolio based on your risk appetite and based on your goals. How do we select the schemes? So first and most important is check the track record. Nowadays there are so many AMCs launching their mutual fund schemes. But personally, I prefer the fund who has been in the market for 5 to 10 years, because then they have established fund manager, established in-house processes, how to select the funds, and their track record is also validated. So whichever category you want to invest, first check the long-term returns of that. Let's say there are 20 schemes in the category. Out of that, see which are the categories which are having good returns over 3, 5, and 10 year 3, 5 or 10 year period. Let's say you shortlisted 5 schemes out of that. Second thing you should check is stability and consistency of returns. Sometimes it happens that in some scheme there is a lumpy return, that in one of the years it performed fantastically, and then again for next 3-4 years it didn't perform. So you have to check year by return and check the stability and consistency of returns. The schemes which are stable and consistent should be shortlisted. Now let's see you shortlisted these 5 schemes. Now what to again filter, if you want to filter it down to two schemes, so then you have to check its current momentum. Okay, momentum is the phenomena basically which lasts for a reasonable period of time. And if some scheme is having a good track record over 3, 5, 10 years, doesn't mean that it may be suitable to current market condition. Example is of Axis Mutual Fund. It was performing fantastically till 2020. All the schemes of Axis Mutual Fund were table toppers. But after this we can say lockdown period, then the Axis schemes are underperforming. So you should not just rely on long-term performance. You should look at the short-term momentum also. So look at the out of these 5 schemes which are shortlisted. Look at the current momentum. Look at 3 months, 6 months, 1 year returns. Because generally it is expected that if they are performing well recently, then they will keep on performing for next 1 or 2 years also. So based on that, second shortlisting should be on current momentum. And once you are shortlisted, then you have to review it annually. Again, after in annual review, you have to check whether the long-term track record is intact and as per current momentum, it is performing or not. If it is not performing, then you can replace it with another scheme. So this is the way basically you have to build your equity mutual fund portfolio. Now we come to the second part. Once you have built a mutual fund portfolio, then there are market cycles or market conditions. Particularly if you are into small caps or mid caps, then during the bear markets or downturn, there will be huge volatility. Okay. So at that time, tactical asset allocation becomes more important. Let's understand what is tactical asset allocation. It is making short-term changes to exploit current market opportunities. The purpose can be to enhance returns or it can be to reduce risk. What are the factors which will influence the tactical asset allocation? It will be market cycles and market valuations. Now, this tactical asset allocation is not abandoning the strategic goals, but we are making short-term changes to the portfolio based on the market condition. When you have to decide going for tactical asset allocation, it generally has to happen at the market extremes. We are talking only in terms of equity markets. So in equity market, if we are at the bull market top or we are at the bear market bottom, that time you should be going for this tactical asset allocation changes. Now, why tactical asset allocation is required? Look at this table. There are primarily 3 asset classes. One is equity, second is gold, third is bond. And this is the data of almost 15 years. You will see that not not any asset class remains at the top in given year. So this position keeps on changing. This shows something like 40% of the time equities are table topper, 40% of the time gold is table topper, and 40% and sometimes let's say 20% of the time bonds give return where gold and equity is not performing. Now you will see which we are going to explain in the further detail. These are the years when market was bad. 2008, gold was outperforming. 2010 and 11, again it was sideways to negative market where the gold was outperforming. 2018, 19 and early part of 2020, there was a bear market in broader market, small cap and mid cap had lost more than 50%. That time gold was outperforming. So gold has a very important role in portfolio. We'll explore that further. So this is the reason tactical asset allocation is important, that you cannot just rely on strategic allocation. Obviously, if you don't want to do any changes to your portfolio and if you have very long-term horizon and you want to just ride out all the cycles of the market and happy with whatever long-term return that asset class is giving, then it's fine. But if you don't want to see the severe drawdowns in the market, or if you want to enhance your returns a little bit more, then you should go for this tactical asset allocation. Now let's understand the behavior of different market caps in cycles. So this is the infographic which basically shows you the performance of 3 different indices. The red line is basically a small cap index, the blue line is mid cap index, and the black line is Sensex. So Sensex basically represents large cap. This data is almost for 20 years and there are 4 cycles covered in it. So you will see every time market is in the rising phase or in the bull market, the small caps are always outperforming, followed by mid caps and then large cap. But what happens during the market downturn? You will see that all the outperformance that is seen in the bull market by small cap is given away during the bear market, and at the end of the bear market bottom, the returns of all categories are same. Okay. Now this is one cycle. Again, you see the same behavior in this cycle. Small cap are outperforming large cap. But when the bear market strikes, again the performance of the large cap or small cap is same. Again, in this bull run, you will see small caps are outperforming, but at the end of the bear market, again large cap and small cap performance is same. Okay, so this is the behavior of different market caps during cycle. In the bottom section, you will see the 2-year rolling returns of these different indices. So you will see that at the peak of the bull market, basically the outperformance of small cap and mid cap index over large cap is something in the range of 20% plus. Whereas when the bear market strikes, the underperformance of this small cap or mid cap scheme with respect to large cap is minus 20%. So you will see that from peak of the market till the bottom of the bear market, the 40% outperformance by small cap and mid caps is given. Now that is a huge figure over a 2-year period. And using this tactical allocation, we can basically either avoid this drawdown or we can enhance the returns. Now, what are the market extremes? Basically, the signs of market bubbles are extreme overvaluations in stock prices because everyone is buying without thinking what is the valuation of stock. The primary motivation is that stock prices are going up, so let's just chase the stock prices. So overvaluation, excessive speculation is derived by the confidence of money earned during the bull market, and everyone wants to participate though. So the participation also increases and the risk taking also increases, and there is a euphoric sentiment, like there is nothing like stock market. It's the easiest way of making money. Let's just open your laptop in the morning, buy something, sell at the end of the day and make money. So these are easy market conditions, and these are generally signs of market bubble. Opposite to that is the sign of market panic. The stocks are undervalued. Nobody wants to buy them at any valuation. Everyone just wants to get rid of the portfolio because every day it is falling and it is creating an emotional pain of seeing those losses. And mostly it is fear driven behavior that market will never rise again. Okay, so these are the basically signs of market bubble or market panic. Historic examples of market bubbles are dot-com bubble, which happened in 2000. After that, market crashed 50%. Then global financial crisis of 2000, again market crashed 50%. COVID low of 2020, the bear market started from 2018, and by the end of the COVID, it was again down 50%. These are the basically cycles of the market, and using tactical asset allocation, you can basically changing the asset allocation, you can take benefit of these cycles and enhance your returns or protect your portfolio. Now, the main important question is how to identify market extremes. So there are many tools. Some tools are fundamental analysis based, some tools are technical based. I'm just presenting here 3-4 tools to you because of the time limitations. Now, most broadly monitored is basically Nifty price to earning ratio. You will see that whenever market is euphoric, so this was the 2000 peak, that time the Nifty P ratio went above 25. Again, in 2008, Nifty P ratio was about 25. At the peak of 2010 bull market top, again P ratio went above 25. In 2018-19 period, again it went above the 25. The COVID, this value is basically anomaly because of because the companies were closed and there was no earnings, so then P ratio short. So this is why you should not look at just one parameter. If you had look at this parameter during after the pandemic, then you might have sold the portfolio. But you should combine various parameters and see the holistic picture and make a decision. One of the parameters is when Nifty P ratio is above 25 levels, then generally it is overrated market. Similarly, when the Nifty P ratio is below 15, then it is undervalued market. So this is one of the tool used to identify the market extreme. What can be other tools? Now these are technical tools. Some might have difficulty to understand. Let me try to explain. So here basically we have plotted the ratio chart of mid cap index upon large cap index. So mid cap index divided by large cap index will give you certain ratio, and that is the chart. Now we have already seen that during the bull market, mid caps or small cap outperform the large cap. So because mid caps are rising in the bull market, their ratio with respect to large cap keeps on increasing. But how far it will increase? So there is a limitation to that. look at this historical behavior in the bull market from 2003 till 2008. It went, it then again in the bear market the ratio came down, because again in the bear market mid cap start and small cap start to underperform. So you will see that this we called in technical terms as parallel channel, and you will see that this ratio basically keeps on oscillating between these channels, and it has a tendency that whenever there is a market top, it will go to the other extreme of the channel. So right now it is showing us that mid cap to large cap ratio is at the peak. That means we are in a bubble phase or euphoric phase, and this should call for tactical changes to the portfolio. Then there is another tool which I compare. Basically, it is mid cap to gold ratio. So gold is an basically hedge to inflation, but equities basically outperform the inflation. So when there is a bull market, it will the ratio will rise rapidly because earnings are rising. So it rises rapidly with respect to gold. But again, when the conditions become bad, then this ratio will come down. So here basically you will see that I'm not able to see this value. Yeah. So when the mid cap to gold ratio is above 18, generally we have seen the market peaks. This was in 2008, this was in 2018, and right now also this ratio has gone above the top. So that means we are again in the bubble or euphoric condition. Right now the per gram rate is something like 7,000 rupees. So you multiply it by 8, it gives you 57,000 range for mid cap index, which is overvalued. Right now it is trading at 60,000. So obviously it is in overvalued zone. And this is the zone where basically bear market bottoms out. So these are the opportunities to buy aggressively. So you should be making tactical changes when this ratio is at the peak and again at the bottom. And there is another indicator, it is called rate of change indicator. So we take 18 months rate of change of Sensex or Nifty. This is the tool to identify the bottoms basically in the market. So here you will see it just checks the prices with respect to last 18 months. And if the prices are in the negative zone, then you will see that this rate of change indicator goes into the negative territory. Okay. So whenever it is in negative territory, that is the time to start again shifting your asset allocation and start going aggressive to the equities. So see, these are some of the tools you can use for making a decision for tactical asset allocation. Obviously, many people may not be aware of these tools. If you want to do tactical asset allocation, then you have to take help of the investment professional in such scenarios. Now, right now we are seeing that market is in overheated territory, and what are the assets which can help you at the bull market top, where you should diversify away from small cap and mid cap towards the other asset categories. So these are the 4 different asset categories which help in bear market, and you should be shifting your assets at least some percentage into this. So first is defensive category funds. There are certain category funds which are not severely affected by the bear market. Second is gold, third is USD INR, and fourth is government bonds. Let's explore each of these asset in detail. So this is the data for last 3 major bear market: December 2007 till February 09, then October 10 to August 13, and December 17 to March 20. We have plotted what are the returns of various categories of mutual fund. So you will see a common theme here in global financial crisis. International funds and pharma funds were obviously they were also in red because the whole world went red, but they were still outperforming the small cap and mid cap category. Again, in the next bear market, you will see that international fund and pharma fund uh, delivered very solid positive returns, whereas small cap and mid cap funds were in the negative. Okay. And similar picture is here, although the outperformance was not in the positive zone, but still the international and pharma funds didn't bleed much. Whereas if you look at the mid cap and small cap, they were in the negative territory. So when you see sense that market is in the bubble zone, you should be diversifying away some portion of your small cap and mid cap for funds to these defensive categories. It will reduce the volatility of the portfolio, or it will reduce the drawdown of the portfolio during subsequent bear markets. Now this is the analysis of gold. I have plotted all the bear markets seen in Sensex over since its inception. You will see that this is the Sensex percent change. Obviously in bear market it is going to give negative return. But if you look at the gold, in each and every bear market, you will see that gold has delivered positive return. Okay. So this is the perfect, you can say, antidote for the portfolio during the bear market. So if you sense that market is at the top, then obviously you should reduce some allocation to equities and increase the allocation to gold. During the bear market, the portfolio will not bleed in line with indices. The positive returns of the gold will compensate for the negative return of the equities. Third is USD INR. I have marked this, basically this red line is mid cap index and the bar chart is of the USD INR. So you will see that this is the bear market on mid cap index of 2008. During this period, the prices of USD appreciated by almost 34%. Similar thing happened between 2011 to 2013. When the market was in negative territory, that time the USD appreciated by 49%. Again, from 2018 till 2020, when the stocks or when the stock market was in negative territory, the USD appreciated by 18%. Now, one of the reasons for outperformance of gold during bear market is obviously because of the USD INR. So when USD appreciate, the prices of gold also appreciate in INR term. So you can either choose to have gold in the portfolio or USD. No need to have both of these things in the portfolio. And last is government bond. We also call these gilt funds. So what is the role of government bonds or gilt funds? Now we see that when the market is in negative territory or the economy is deteriorating, that time central banks are forced to reduce rates. Now the performance of bonds is inversely correlated to interest rate. So when interest rates are coming down, generally the returns from the government bond increases. Normally, the gilt fund yield something like 7%. But if you look at this period when the interest rates are falling, in that period it returns 13%, which is something like, which is even better than large cap and something similar to a mid cap kind of return. So these are some special opportunity windows available for 1.5 to 2 years. When there is a falling interest rate regime, that time gold gilt fund give exceptional returns. And right now we are seeing that the Fed or the central bank of US is on the path of downward interest rate. Generally, when the US reduces the interest rate, the Indian central bank also follows. And I am anticipating that over the next 1 to 1.5 years, again we will see these gilt returns going into the 12 to 13% kind of returns. Okay, so let's summarize. For tactical allocation, if you sense there is a bubble, what you should do? You should reduce your equity exposure, shift away from small and mid caps to large caps, shift, allocate some portion to bonds, gold or USD. It will help to navigate the bear market. It will reduce the volatility of the portfolio, and in some case it may enhance the return also. Also invest on defensive sectors like a pharma fund or consumption fund or global equity, which basically doesn't bleed in line with the Indian indices. The tools used for identifying the bubbles, some of the tools I have shared Nifty P ratio or mid cap to large cap index chart or mid cap to gold chart can be used to identify these bubbles. What should you do in panic? In panic, increase equity allocation. When everyone is fearful, you should be greedy. Shift to small and mid caps aggressively, because we have seen in the infographics that the best time to buy small and mid cap funds is when there is a blood on the street, when the times are very, very difficult. It is counterintuitive, but we have seen based on the historical performance that whenever the market has crashed, that is the best time to go for small and mid caps, because in the subsequent bull run, they will outperform everything else. Deploy additional cash if you have some savings. Then when you see the market panic, deploy that additional cash for buying equity assets, and maintain a balanced approach. These cycles keep on happening. So whenever bear market happens, people think that the world is coming to it, but there have been so many bear cycles in the market. At some point, market finds the support and then it starts to come back up. So maintain a balanced approach to avoid emotional decisions. Okay. Let's summarize. Asset allocation is decided based on risk profile, goals, and time horizon. Decide your risk profile, decide your goals, decide how long you want to be invested, and based on that, create a portfolio. Tactical allocation kicks in at market extremes to enhance return, or it may be also to reduce risk. So when you see bubbles or when you see panic, that time do tactical changes to your portfolio. There are several different ways to manage portfolio risk at overvalued markets and euphoria. We have already seen that diversify away from small cap and mid caps toward large caps or defensive category mutual funds or gold or bonds. And adding this non-correlated asset, which are basically gold, bond, or USD, in stressful time reduces portfolio volatility drawdown and gives stable returns. And with this, we come to the end of this webinar. Our services are wealth management. We do mutual fund, PMS, and AIF distribution. So if you are looking to build a investment portfolio using this investment products, please get in touch. Apart from that, I also do direct investing program, which is called a multi-bagger investing program. It's a completely systematic approach to buy small caps and mid caps in the bull run and to outperform indices. So if you are passionate about direct investing, you can, and if you have interest in building a portfolio of high growth multi-bagger stocks, then this program may be suitable for you. If you are interested, please get in touch. And now let's open it for the Q&A. Dr. Srishti.
Thank you so much, Mr. Zafar. It was a lovely presentation and very insightful and very methodical and very practical. We have some questions, so I'll take questions one by one. We have a question by Mr. Bhavesh Solanki. He's saying he follows you on Twitter since a long time, and he's aware about your expected upside targets for all major indices. Just wanted to know that how much downside you are expecting once indices reach your targets on upper side. Thank you.
Okay, so if you look at the bear market historically on small cap indices, then these bear markets have been anything from minus 30% to minus 75%. Okay, so we can't exactly identify what can be the maximum downside, but this is the range. If once the bear market hits, you expect from peak, you will see somewhere between minus 30% to minus 75% at the index level on small cap index. Large cap, it may not be that, because large caps are less volatile, but small cap and mid caps can fall 30 to 75%.
Right. Mr. Ankit Agarwal is asking that is the ratio chart on log scale?
It doesn't make much difference. Right now it is in log scale, but if you plot it on log scale or linear scale, it won't make much difference, because log scale are used when the values are starting value and ending value is highly different. Like if a stock starts from 10 rupees and over a 10-year period it goes to 1000 rupees, that means it has become 100x. So that time seeing the chart on linear scale doesn't provide, you can say it doesn't look visibly appealing, and analyzing also become difficult. So in that case, you should be using log charts. But in ratio charts, the range is not that wide. So in case of ratio chart, you can use linear or log, anything is okay.
Right. Mr. Kapil Mogha is asking that is gold at 75K a value buy?
It's not a value buy, because as per my analysis, I see international gold prices going to something like 2900 to the dollar. Right now, it is something like 2600, 2650, something like that. So I
Every
see
day, new
further
high
10.
prices of gold. Trust me, the woman in me feels so happy.
So I'm expecting that in INR terms, gold can be in the 85 to 90,000 range over next 1 or 1.5 years. But it is not value buy, it is not cheap. It should be added to the portfolio as a hedge and nothing more.
Right. We have another expert here, Vijay sir. Vijay sir is asking that in your opinion, are we in a bubble?
Yeah, definitely.
Right. All right. We have some more questions in the chat box. Yeah. So, yes, Mr. Tushar Chaudhary is asking that in which funds should we invest generally for SWP for regular income if a person has moderate risk profile, like 40 years of age, married with a 7-year-old kid living within means? That's, I think, a very valid
Okay, I
question.
didn't
I would
get the
ask the same.
question.
Yeah. So he's asking that how should he invest for systematic withdrawal plan like SWP as a regular income if right now we are in 40s and moderate risk profile, married, having a kid.
Okay. So basically, it is kind of a retirement planning, and it depends on when you want to
Yes.
withdraw. So let's say if you are 40 years and if you want to activate SWP at the retirement age of 60, so you still have 20 years of accumulation period in your hand. Again, as I said, if you see the market panic, if you have risk appetite, then you should aggressively go for small cap and mid cap fund if you have risk appetite. Otherwise, multi-cap funds are better. And once you reach that stage of distribution, when you want to do SWP, that time you should not have allocation to equity very high. So in that stage, when you are accumulated, you can shift it to the hybrid category of fund, which can be aggressive hybrid, conservative hybrid, or it can be a kind of dynamic asset allocation where the fund manager shifts the allocation based on the market conditions. So when you are accumulating, let's say if you want to accumulate for 20 years, then go for aggressive funds. And when you reach that stage, when you want to activate the SWP, then go for hybrid funds, which will be more conservative.
Right. Mr. Bhaskar is asking, is there any technical indicator to identify the sector funds from index charts?
There is no technical indicator, but there is something called relative strength. So basically, what you have to do is see the performance of different indices over last 3 months, 6 months, or 10 month or 12-month period. That is the short-term momentum period. And if you see that there are certain segments which are basically some certain sectors which are basically outperforming other sectors, then you have to take a decision for going for that category of that we can say thematic kind of fund or index fund in that particular sector. So the
Right.
technical tool for that is basically relative strength. You have to track relative strengths over last 3 months, 6 months, and 12-month period. And when you see that a certain sector is outperforming, go for sector funds in that category.
Right. Yeah,
Like
Ankit
there's an
is saying.
example I had given this PSU PSE call. So this PSE index was for last almost 14-15 years it was in the range. The range was something like 5,000 and 2,500. I don't remember the bottom, but upper range was 5,000. And when it breached 5,000 level, that was the breakout of last almost 15 years. And that time I gave the call to buy basically PSE. So there was ETF available in that, and that has been the like most outperforming sector over last 2-3 years.
Right. Are you talking about Bharat 22 ETF?
Yeah, it can be Bharat 22 or there is a PSE ETF also, which basically has all these PSU stocks.
Right. Would you recommend buying them now?
No.
Vijay sir is also saying that, sir, how can we define a bubble? And if we are in a bubble, then should we get out of all equity?
It depends on what kind of investor you are. So you are if you are all in all out kind of investor, then definitely you should get out. But most of the people don't have this timing skill. So rather than going all out, they should, as I said, that move away from aggressive categories of small cap and mid cap and move into large cap defensive and add other assets also, which basically will provide the comfort in the downturn.
Right. I am following Vijay sir also for a very long time, very learned and inspiring person by the name of Sanik on Twitter. I think you also must be knowing. So
Yeah,
Vijay
I
sir,
follow him.
yeah, so Vijay sir has been quite a lot into gold and silver and into defensive pharmaceutical companies and all. And we did a very nice webinar with him in which he shared his insights about gold and silver. And we did it like a couple of months ago. I
Yeah.
think gold was at around $2,100 at that time.
Yeah, that was the
Yeah.
breakout point. From that, it has continuously rallied.
Yes. Mr. Ankit Agrawal is also asking that, can other metals be also a hedge against inflation in falling interest rate environments such as silver or copper? Does ratio chart of gold to silver and gold to copper indicating anything?
I don't track these ratio charts, but if somebody has interest, then they can plot and definitely get insights from that. Copper also is a hedge against inflation, but if you look at the long-term performance of copper versus gold, then you will definitely see that the gold has continuously outperformed because gold is considered an asset, whereas copper is considered an industrial commodity for consumption. Okay. So if you are thinking of investing into the commodities for hedging inflation, then there is nothing better than gold. Silver, basically, silver is also in line with gold, but because it is uh, perishable, it becomes black or something like that. So people generally don't hold physical silver. And right now, if you look at the ratio chart of gold versus silver, then gold is obviously outperforming the silver. But there are basically in this commodity bull runs, there are spikes where the gold, silver also gives very fantastic movement for short duration of time. So right now, I am expecting that as per the system, it is showing appreciation of right now it is something $30 plus, and I have a target around $50. So that indicates a 40% kind of appreciation in silver that is possible.
Right. Vijay sir is also saying that, sir, you said exposure to equity should be 100 minus age. Buffett is 95 years.
So it is basically we can say a general rule for working population. They are not Buffett. Buffett is a professional investor, and
Yes,
most of the guys are basically planning for their retirement. You know, particularly middle class, upper middle class, they don't have the luxury of Buffett of seeing those kind of drawdowns on a $1 billion portfolio. The portfolio is in few lakhs, and because of the inflation, most of the time these guys have to even break their investment portfolio, so they are not able to follow that portfolio itself with discipline. Okay,
true.
for them that downturn basically pinches a lot. Somebody who has made decent gains in bull run, now he has a portfolio of let's say 50 lakh, and if he sees that portfolio 25 lakh next year, so his feelings will not be like Buffett.
True. Sir is also asking, Vijay sir is asking that, sir, usually the last stage of a bubble is where you get very high returns in very less time. For instance, in between September 2007 and Jan 2008, 4 months, Nifty went up by 40%. Don't you think that we should buy aggressively during this period?
No, I don't think because when you compare two different eras, you have to understand what was the market capitalization of India during that period of 2003 versus 2003 to 2007, and what is the market capitalization right now. I don't think we were even 1 trillion in that period. We are now 4.5 trillion market. And as the market evolves, it also matures, so the percentage movements cannot be similar. Like even in Nasdaq, if you see the bull run from 1980s to 2000, the percentage movement were humongous. But in the recent bull run from 2009, we are not seeing that kind of euphoric buying because the market cap has increased and the market also has become mature. So what I do basically, rather than comparing these percentage moves, I translate them into a technical tool called ATR, which is average true range. Average true range basically tells you that in a certain period how much that particular stock or index moves. Okay, and then you can compare the similar average two range movements for that period. So I had recently tweeted that the movement from September 2007 till the peak of 2008, that was 10 ATR move, although that time it was something like 40-50%. But if you look at the similar ATR move on Nifty, it translates to something like 5,000 points, which is like 20%. Okay, so
Right.
the volatility of that era was different. The volatility of this era is different. So we cannot have a like to like comparison. And for that, my more preferred measure is average true range rather than percentage range.
Right. So you think that Nifty can go up like 20% more still?
Not 20%. That call was something like 25,000. So I'm expecting that Nifty can go in the 28,000 to 30,000 range.
Right.
20,000 is calculated based on the another methodology which we call as log scale Fibonacci projections. Based on that, I have calculated this target for various indices. So as per that, Nifty shows the range of 28,000, mid cap index, which is right now at 61,000. It shows the target of 68,000, and small cap index which is at 19,200, 500, it shows the target around 22,000. Now this
Right.
basically targets are just for references. You cannot pin it that it has to reach this level. Okay. In my opinion, we are in the last 10% of this bull run. So I'm already telling people, I myself is reducing my equity exposure over next 2 to 3 months.
Right. Namrata ji is asking how to invest in USD INR. It's no longer available to retailers.
Yeah, that's the problem. USD INR is not available, so we don't have any option right now.
What about
Earlier
investing?
there were futures in NSE, so we could just buy USD INR futures in NSE, but I don't think that option is available right now.
What about going
The
for dollar
alternative to
TLT?
alternative to USD is basically gold, because the appreciation of gold is directly related to the USD INR, because we import most of the gold. We are not producers of gold. Okay, so when we import, because of the currency difference, if the USD INR appreciates, then obviously the domestic prices of gold also increases. So your gold is a proxy, not exact proxy, but it is a proxy for USD INR investment.
Can we invest in US bonds like dollar TLT through IND money?
I am not aware of IND money, but there is a platform called Interactive Brokers which allows Indians to invest in global assets. So we can invest through that.
Right.
Provided we are not doing future and options trading, I think it is allowed.
Dilip ji is asking how to invest in gold.
You can buy gold Bs. There was a fantastic option of SGB, sovereign gold bond, which was tax free and it was giving to 1.5 or 2% additional, but now that option is not available. And right now, because the RBI is not issuing any more SGBs, so the current SGBs are trading at premium, so there is no point buying in that. There is an option to buy a gold ETF. It's called gold Bs. So you can just search on your broking platform gold Bs and buy the gold Bs.
Gaurav ji is asking, do you plan to launch any small case in future?
I had my small cases. I was SEBI registered investment advisor, but then I changed my approach. There are already so many products available in the market, but investors don't know which product to use at which time. So more important is asset allocation and making tactical changes based on asset allocation. So I thought that rather than having my own product, let me make use of all the products available in market and help people to create wealth, preserve wealth, grow wealth.
Right. Tushar ji is asking, after every Fed rate cut cycle, Nifty has fallen for the first year and gradually recovered from the second year. This will it be different for our markets, given we are in structural bull market and US consumer demand is still strong from savings since COVID 2020?
See, these are nobody can predict the future. What we can analyze is basically repetitive patterns of the market. And if you look at the fundamental as well as technical parameters of the market, then obviously if you compare the previous cycles, then we are in overvaluation territory. Obviously, see, if the stock is becoming 10x in a year, but if the business is growing only 2x, so how do you justify that valuation? Okay, and right now we are in that phase where the stock prices have run ahead of the business growth. Okay, so in that sense, the market basically corrects due to overvaluation itself. There can be different ways to correct. One is obviously a vertical collapse where the like 2008 or like 2018 to 20, where the market crashed heavily, small cap index crashed more than 50-60%. There is another type where basically market remains in a you can say range bound kind of zone for a long period of time. There was such period in the US when from for almost 6-7 years the index was in the range which was very narrow. After the crash of 87, market recovered and then for 6-7 years it remained in the tight range. So that is one of the possibility. But looking at the history of our market, where the small caps, when they start to correct, there is nothing less than 30%. So, so I'm not expecting that we will be in that tight range, especially for small cap. It is possible for large cap, but small cap generally have that pattern that there will be bull run and there will be correction, and all the bear markets or correction are more than 30%. Obviously, as market evolves, there can be new pattern that I can say is a hope. I just go by the previous cycle. So my most analysis is based on repetitive cycles. And based on that, I get my conviction that whether we should be fully invested or we should reduce the exposure. So based on
Right.
those historical patterns, I'm expecting that that pattern may be repeated. The reasons may be different. In 2000, it was global financial crisis. In 2018, it was because of something called Fed taper tantrums, where they raise the interest rate and then the market collapse. So market can have different reasons for correcting every time, but general pattern of this correction repeats, and I just go by those patterns.
Right. Mr. A.K. Srivastav is asking how you see real estate as investment for bear market, especially after new LTCG tax.
First of all, I am not expert in real estate. Second, I had expected that the kind of liquidity conditions that existed in pandemic, so another real estate cycle should start. And I think it has partially played out since COVID lows. The real estate prices have increased, not across the board, but mostly in urban areas or land parcels. The prices have increased. So I think that we are some way in the middle or latter stages of that real estate bull run. Real estate also has cycles in the sense it doesn't correct like small cap or mid cap indexes. But there is a time when real estate prices rise rapidly, and after that they either don't rise or they rise very gradually. So we had this bull runs in real estate from 2003 to 2009-10, where the real estate prices rose very rapidly. Then from 2010 till 2020 till lockdown, it was not rising or it was just marginally rising. Then again after the lockdown or pandemic, the real estate prices rose substantially. And once when it ends, then again there might be a period where real estate prices doesn't basically increase so rapidly. I cannot. I don't think it is a good idea to think real estate as an investment apart from your primary residence, because there are so many other opportunities available where you can basically change the allocation matrix regularly. That luxury is not available in real estate, being illiquid assets, and on every transaction you are paying 7-8% to the government itself. Okay.
True.
So to recover that, and if you're borrowing property on loan, then the interest charges, it doesn't make sense to get out of the real estate in 2, 3, 4 years unless the property prices are rising very rapidly. It should be
Right.
investment of at least more than 5 years. And because of illiquidity and other concerns, I prefer investing in the other investment products available rather than real estate.
Right. We have a question about NPS by Mr. Vijay C. Tier 1 auto choice. I am in 50s with around 50% allocations to GSEC, 15% to C scheme, and around 25% in E scheme. In current market scenario, will it be a wise decision to change auto choice to active and increase equity scheme allocation in form of SIP, or should I wait for a correction? Will it be good to opt 5% to a scheme?
Okay, so I am not an expert in NPS and I don't really understand this ABC or whatever the schemes are. But if the question is that whether you should shift lump sum to the equity, I will say no. If you want to shift to the equities, do it in a staggered way. There's something called STP, which is systematic transfer plan. So what I am advising right now is go for a systematic transfer plan over next 24 to 36 months. The reason being that the bear cycle doesn't generally last more than 24 months. The minimum duration is around 12 months, maximum 24 in general. So it won't last more than 24 months. So if you do it in STP way over next 24 months, then gradually your equity investment will keep on happening and you will not have that sudden impact if the market crashes. So rather than doing it in lump sum way, do it in STP way. And if you are doing SIP, continue the SIP.
What is the difference between STP and SIP?
So SIP is basically systematic investment plan where you decide that, okay, these are two funds where I want to invest every month. Okay. And STP is shifting between one scheme to another scheme. Okay. So let's say you have a SIP in small cap fund for going on for last 10 years and you have accumulated a substantial corpus of 1 CR. Now, if you want to do tactical allocation, asset allocation, then shift away from small cap to let's say large cap. So you can put on a STP where you select the two schemes, the small cap scheme and the large cap scheme, and keep transferring every month from small cap to large cap, provided the schemes are within the same AMC. So if you want to do STP, it has to happen in the same AMC. Like the small cap fund is of ICICI, then you can shift to the large cap fund of ICICI only, not to the HDFC or Nippon.
Right. Bhaskar ji is asking, so currently small cap index is overvalued, but most of the small cap companies with good fundamentals still trading below 2015 level. Is it only small cap index in bubble or it's applicable to all small cap stocks? One of the charts says market crash happened in 2000, 2018 and 2020. The difference between each crash around 8 to 10 years. Now we are just 4 years from previous crash. Do you think that next crash will happen in next few quarters?
So first of all, I am not saying that it will crash. It can be a gradual grinding kind of correction also. What kind of bear market or what kind of correction we get, we cannot anticipate that. 2008 was a vertical fall. 2010 to 13 was a grinding kind of bear market. 2018 also in initial phases it was grinding kind of bear market, and because of the COVID again there was a vertical fall. So we can't say what kind of fall we get. Second thing, the difference between two bear markets being 8 to 10 years is right, but it doesn't follow precisely like that. I also follow this 8 to 10 year cycle, which is called Benner time cycle. So we had a major peak in 2000. We had after that we had major peak in 1992 of Harshad Mehta. Then we had a major peak in 2000, which was again after 8 years of Harshad Mehta, which was dot-com bubble. Then in 2008 we had this global financial crisis. So going by that sequence, next stop should have been in 2016, but it came in 2018 at the broad market level. So these models cannot be so precise that the correction cannot come before 8 to 10 years. So you have to be prepared.
Right. Vijay sir is saying 40% may be an outlier. How about 18%, which is the average of all moves from first time when Fed reduces interest rates?
I didn't understand the
Yeah, I think I'm not able to get the perspective, Vijay sir. 40% may be an outlier. I think we'll go to next question. I'll wait for sir to respond to the question. And I think with this, we are done with almost all the questions. I think we really got a good involvement and people had a lot of questions, which is good. Yeah, I think we should be good to conclude. We have one message. Yeah. Acha, Vijay sir is replying that every time Fed reduces interest rate, Indian markets have gone up by at least 18%. Sir is saying that.
Okay, I have not studied that in so much detail, but again, I'm saying that we cannot compare the percentage movements of these different eras. Based on my model, I am expecting that it will be something like 10 to 20%. Some part of that movement is already played out.
Right, right. Thank you so much, Zafarji. I think we've taken up all the questions. Almost all
If you
questions
have
are
any
done.
other question, please forward it to me. I will try to revert to that.
Oh, great. Yeah, Vijay sir is saying that in 2018, it is the last time it happened. I think the Fed reducing the interest rates. That's what sir is saying.
Yeah, so basically when Fed started in 2018, I think we had already topped out by the time Fed started reducing the rate. We're already in bear market.
Okay. So, right. Sir is saying, yeah, 2019. Sir is saying 2019. Yeah. And Vijayji is saying, can you please take the REIT question? Okay, there was a question on REIT.
Real estate investment trust.
Yeah, 1 second. I should go up. There should be a question on REIT. Where has it gone?
Yeah, I know about real estate investment trust, but I have not studied that in detail.
Okay, okay.
Yeah, so
Right. All right. Thank you so much, Zafar. I think I'll share Zafar's Twitter link also here. Zafar, can you please share your Twitter ID with everyone?
Yeah. Should I share it in chat box?
Yeah, that would be great. So yes, I think Zafar would be more than happy to interact on Twitter further on. And he has a wealth of knowledge. Yeah, he has written his Twitter ID, that is @Invests Capital. So yes, that's his Twitter ID. I think we should follow him, and he has great insights to share and lots to learn from him. And a wonderful person. He always responds. So thank you, Zafar. We have made a great conversation today. So thank you for a lovely time and lovely insights. And I would request that please take help of professionals. Sometimes it's good to keep your money safe with people who know how to handle in different times and sail their ships in different waters. So with this, I would like to conclude. Thank you everyone for joining tonight.
Thanks a lot. Thanks everyone for joining.
Thank you, everyone.